Hello guys, welcome to my YouTube channel. In this video, we are learning about law of one price. Law of one price is a principle in economics that states that identify goods or assets in different locations so sell for the same price when factors such as transportation cost and trade barriers are taken into actions. This principle applies to goods that are easily traded and have low transportation cost, such as commodities like oil, wheat, or gold. The law of one price is important in economics because it suggests that arbitrage, not the practice of buying a goods in one market and sell it on another to take advantage of a price difference should be possible in the absence of transaction cost. If prices of the same goods different in different market, then traders should buy could buy for the low pricing market and sell in the higher market price, which should be drive price of towards equality. Example of product that should have equal prices across borders including commodities such as oil and gold, which are traded in a global market and should have similar prices in different countries. Additionally, products that are mm, produced by global brands such as Coca-Cola or Nike should have similar prices in different countries due to the competition presence of global markets. Finally, goods that are subject to international trade agreement should such as agriculture product and manufacturing goods should have equal price in different countries to prefer unfair trade practices. After introduction, the next topic is definition of one price. The law of one price is an economic principle that states that identifying goods or assets in different locations should sell for the same price when factors such as transportation cost and trade barriers are taken into actions. In other words, if two goods are identified in all aspects, that price should be the same regardless of where they are being sold. This is the important step in international financing. In theory, the law of one price works because of the force of arbitrage, which refers to the practice of buying a goods in one market and selling it on another to take advantage of the price differences. If prices of the same goods different in a market, then traders could buy from the lower pricing market and sell it in the higher pricing market, which could which would drive price towards equality. Arbitrage could continue to buy from the lower pricing market and sell in the higher pricing market up until pricing converge. In practical, the law of one price can be applied in various ways. For example, the price of the commodities such as oil should be the same in different countries after accounting for transporting cost and other trade barriers. If the if the price of oil is higher in one country than another country, then trader should would buy oil from the lower price country and sell in the higher price country, which would derive the price towards equality. The same logic applies to other commodities such as wheat or gold. Example of law of one price. Another example in is in the pricing of identifying goods produced by global brands. For instance, the price of a Nike shoe should be the same in different countries as the brand face uh, competition in a global market. If the price of the Nike shoe is higher in one country than another country, that consumer should buy the shoe from the lower priced country, and arbitrate will sell it in the higher price country, which would drive the price towards. The law of one price can also be applied to financial assets such as stocks or currencies. For example, the price of a share of Apple stock should be the same in different stock stock exchanges around the world after accounting for exchange rate and other transaction costs. If the price of Apple share is higher in one exchange than the another, trader would buy the stock from the lower prices priced and price exchange and sell it in the higher pricing exchange, which would drive the price towards equalities. In conclusion, overall, the law of one price is an important principle in economics, as it suggests that prices of identifying goods or assets should convert across different markets, promoting economical intervention and global trade. This is the first part. The next part will come.